Okay, peeps, welcome back. So today we're going to be talking about the long-awaited CPI data expectations. Let's get it. So, as you guys can see here, we are on the BLS website. This is bls.gov or the Bureau of Labor and Statistics. These are the guys that comes out with the CPI release numbers according to each sector of the market, like food, energy, housing, so on and so on, and kind of gives us an overall view, snapshot picture of what the overall inflation percentage or amount is. So the CPI data is going to be released on October 12th, which is in 2 days at 8:30 a.m. This would be Eastern Standard Time, or if it's Pacific Standard Time, if you're on the West Coast, that would be 5:30 a.m. I will not be trading in the futures markets on that day because I have to work on that day. And even if I was, I am not going to trade the CPI release because it can be extremely volatile. And I mean, it can move like 40 or 50 points within a 5 minute or a 1 minute time frame. It is suicide to trade something like that in the futures markets. So hands off for me. Even if I was going to be off, I wouldn't start trading until probably an hour after the actual release, just to kind of see what the market's going to do and how it's going to react. So, why does the inflation report matter? Well, it matters because it is one of the major determining factors, one of the major metrics that the Fed looks at in determining whether they should continue raising rates, hold rates at a pause. I don't necessarily agree with their higher for longer rhetoric. I think that's a bunch of nonsense. I think, in my personal opinion, that they probably are just saying that to spook the markets so they can, continue to bring their benchmark down to 2%. But that's just my opinion, of course. Or the CPI could determine whether they're going to begin cutting rates. So, in 2 days, this will be released. Now, what are the expectations? The expectation, according to this website, I'll leave it in the description for you guys down below. This is investing.com. The headline CPI report, expected inflation report, is going to be 3.6%. So basically, we'll just see like a 1/10 of a percentage point drop on the CPI. I think it will actually probably be a lot lower than this expectation. Reason I say this is because one of the major metrics that we look at in terms of the inflation report is energy or oil. Oil has dropped a substantial amount in the last month. We would like to see inflation come back down to 3% or subpar 3%, just to convince the Fed to kind of lay off the gas and be like, okay, we're going to start cutting rates now. Our personal opinion is that we think that the Fed is going to begin cutting rates by the end of the year, the end of this year of 2023, or by the absolute latest in Q1 or by the end of Q1 of next year. Why do we say this? Because they've been holding rates steady for a while. By the time the end of the year rolls around, they would have been holding rates for quite a few months at that point. And they can't just keep holding rates forever because it's expensive for the U.S. to pay interest on their debts the longer that the Fed funds rate is elevated. And on top of that, eventually they're going to end up destroying something in the economy and they're going to have to come in and fix it. Plus, you also have presidential elections next year. Not only is the next president going to be elected next year, but also a lot of the midterms is also next year, which basically means like a lot of the senators or governors' seats are going to be up for election or re-election, depending on whether they get their seat back or not. And so basically all of Congress is not going to be, we'll just put it like this. It looks bad if the stock market's dumping or the Fed funds rate is still really high and we're not in a growth cycle when the election process takes place. So Congress and the president or the would-be president at that time, they're not going to want to see the markets dumping into their elections because it looks really bad. So they're probably going to come out and be like, hey, Fed, you need to start cutting rates, because if you don't, we're not going to get elected, and we're kind of your bosses, so you have to do what we say. That's more or less what that picture goes like. Another thing to keep in mind is we have earnings on deck. These are all major factors that contribute to whether the markets go up or down. So there's a lot of earnings on deck. Pepsi had earnings today. From the looks of it, they had a beat, which is great. You got Rite Aid, you got some other companies here, Louis Vuitton. Looks like you have Walgreens down here, which is one of the positions we own. Domino's Pizza, PIMCO Income Strategy. This is not the PIMCO ETF that we own, but it's probably in that family category. And just a lot of other major earnings that you got going on. United Health, JP Morgan. So you got the big banks here. Then you have like a lot of earnings going on here. Bank of America, Lockheed Martin, Goldman Sachs, Bank of New York Mellon, Interactive Brokers, Albertsons, so on. I could keep going on about this, but major earnings season is coming up, which is one of the reasons we believe the market's going to pop off to the upside through the end of the year. Plus, you have the consumerism aspect. A lot of people are going to be buying for holidays like Halloween, Thanksgiving, Christmas, New Year's, so on. So, with that being said, the next FOMC meeting is going to be taking place at the end of this month, beginning of next month. So, the Fed's going to be taking a look at this CPI report and saying, so if headline inflation comes down to 3.6%, the Fed's going to say, okay, that's good. But if headline inflation goes down to like 3%, the Fed's going to say that's great, right? What the markets want is the Fed to be as bullish on the outlook as possible. What does the Fed need to be bullish in current circumstances? They need to see CPI come down consistently month over month and get as close to their 2% target as fast as humanly possible. So that FOMC meeting will be happening about 2 to 3 weeks after this CPI this week. Another thing that we look at here on the channel is the futures, S&P, and oil futures settlements and quote prices. We've brought this up before, as you guys can see, throughout the end of this year and the end of 2024 markets. The projected settlement prices are basically to be going up through the end of next year. You see about a 4,600 price target just after 2024. Again, we do not work for the CME. We don't know if these are set in stone prices or not, but a settlement price would indicate that that is what the price is going to be. Just my opinion, of course. As you can see, it's pretty similar here. You get your settlement prices. So 43.68 would be the settlement price, or the supposed settlement price, for the end of the year. If we go over here to the watch list, you guys can see that the SPX currently is at 43.60. It's had a pretty large move up. If we go down here to the futures version, you guys can see that the futures version is at almost 4,400. We did trade futures this morning. That's the reason why our video on GXLM got out so late. We only have so much time to do stuff, so we try to get it to you guys as soon as we can. But yeah, so the price is pretty much on track. We're expecting the prices to go up in the following months and quarters. Something to understand about the S&P or the equity indices futures in general is they settle on a quarterly basis. So every 3 months, 4 times a year, which is March, June, September, and December. The futures contract front month will be rolled forward for the next quarter. That's typically how it works, whereas crude oil is different. It settles or rolls forward every single month. So just understand that about futures. As you guys can see on the settlement prices, the oil prices are expected to go down as time moves forward. Again, we're not sure if these are set in stone or if they are quotes for the future and subject to change. We don't work for the CME, so we don't know this for sure, but we're kind of going with the estimates here that oil is expected to drop. So oil dropping is a good thing for CPI because the more oil drops, the lower the energy sector is of the CPI read, which means that CPI, the inflation rate, will ultimately come down. So one more thing I want to look at here with you guys is the oil futures. So if we take a look on the weekly, as you guys can see, basically from, if we measure from the, well, let's actually move this to the daily so we can get a really, really good look at the picture here. So if we were to measure this from the start of September, let's take the start of September, which is basically this candle right here, and we were to go to the start of October, you guys can see that oil would be up 11% on the month. What we want to see going into November is basically that the oil prices would have peaked out here in September and probably move down to maybe like, I would say maybe the support range down here at like $78 or something, or maybe even perhaps as low as 84. Or in general, what we want to see is a negative month over month read for oil in order for CPI to come in lower, in order for the Fed to be more bullish on cutting rates, or to start turning dovish. Dovish means that the Fed's bullish, hawkish means that the Fed's bearish. So that's some terminology for y'all. So anyways, these are the CPI expectations for this week. As you guys can see, the headline CPI is at 3.7, core is at 4.3. Ideally, we want to see both of these come down. That would cause the Fed to want to stay paused and or cut rates depending on how much it comes down. Our expectation, what we believe is going to happen, is that the Fed will start cutting rates sometime between December this year and March of next year. But anyways, this is the CPI expectations for this week. We hope you all enjoyed this content. If you have any suggestions or comments, leave them below. And please like, comment, and subscribe, and we will see y'all later. Peace.